Thank you very much for joining us today. It goes without saying that we've all been confronted with a situation that's unlike anything we've really ever seen, particularly inside New York. And for everybody on the call, particularly inside the New York City rental ecosystem. And there's just an incredible market dislocation that is happening there. We're in the midst of it. Nobody really knows where we land and what the other side of this could end up looking like. I think one thing all of us probably can agree on is the New York City resiliency is definitely there, and I'm pretty confident that we'll come back from this in good and incredible ways. But for right now, we're sort of still in the thick of it. We wanted to dip into the current environment a little and understand not only where we're headed, but also a little bit about where we are. We've got a little bit of data now. Last couple of months have given us a little bit of sense of the impact into this ecosystem. So we want to talk about that a little bit as well. And what we did was convene a group of experts that uh, are each leaders in their respective fields. They've each guided their organizations through prior crises, and each one of them have a position that we think is valuable in terms of providing insights and observations about where we are and where we may be headed. Like a lot of these webinars right now, this will be a Q&A format. I'm going to be asking questions. We'll use them as conversation starters, and we'll let the discussion kind of range from there. We'll hopefully get to everything we have on our agenda. We may not get to everything. And in the midst of this, as we're talking, if you have a question, please use the Q&A link that's down in the middle of your screen on the Zoom dashboard to submit your questions, not the chat panel. We're going to try to get to as many questions in the Zoom as we can. And you'll hear me probably try to weave some of those questions into our conversation as we go. So we may not have time for a true Q&A session, although we may. Kind of depends on where we go. Very important, after the program today, we're going to send you a very brief survey, literally like right after you hang up after we're done with the Zoom discussion. Kate will push through a survey to you. It's very brief. Please take a minute to fill it out. We just need to get your opinions on what we discussed today, any additional questions you have, and potentially what a future webinar topic or topics could look like. Let me make a few quick introductions as the moderator of the webinar. My name's Steve Lord. I've been a strategic advisor to Elegran now for a little over 2 years. Got about 25 years of experience now in middle market CFO, CEO, and COO engagements. Began my career providing sophisticated financial and macroeconomic research to institutional investors in New York. And I'm also heavily involved in disaster relief as a liaison officer for FEMA's Region 2, which is New York, New Jersey, and Puerto Rico. So in the current environment, I've been pretty busy. Turning over to our panelists right now, we have Adam Meshicow. He's one of the founders of LEAP, which provides rental default insurance for multifamily housing across the United States. We have Joe Ben-Zvi, who's the founder of Vero Leasing, which is a virtual platform enabling renters, property owners, and brokers to complete the residential leasing process very quickly, very easily, and with a lot of security. We also have Jared Anton. He's Elegran's Chief Everything Officer, as we kind of call him, and he's officially our Director of Sales. He's responsible for the sales team at the firm, their professional development, and Jared has been involved in the real estate market through himself or his family, really since he's been around. He has extremely deep knowledge across both rental and sales brokerage. We also have Ron Zhang. He's Elegran's Director of New Development. Many of you guys on the call know Ron. He manages our relationships with developers and their leasing operations. So, kicking this off a little bit, we are in a new world, right? And you hear this in every webinar, everything you guys are dealing with, all of the business information you have, all of us have a pretty strong demarcation from, where we were, say, January to where we are now. What has the effect? I mean, if we can sum it up into a couple key phrases, what do we think where we are now has become visible in things like traffic, in inquiries, in applications? I mean, I can give a lot of background on where we are with COVID. We may have a boomerang effect coming into October with a second wave. Everybody's worried about this. New York is still on pause, but for right now, maybe Ron, we can talk briefly around what are you seeing in terms of leasing traffic, inquiries, applications?
Sure. Thanks, Steve. A lot of the data that I'm going to be talking about today will be coming from Sky, which is the largest freestanding single structure rental building in New York. So that's where, just to give everyone a background, that's where a lot of the data is coming from. From our side, we're seeing leasing traffic down about 30 to 40%. With that being said, we're still having visits, a lot of virtual visits, and a lot of applications coming through every day. Through the heat of the crisis in last month, we still did about one deal per day at Sky. Right, so that's still like a good amount of deals coming through. But compared to a normal leasing season in the spring, the traffic is down, a lot. And usually when we're back at the office at this time of the year, we could have up to like 30 to 40 plus visits per day. So, obviously that's not the case right now.
Right. Okay. And, you know, what do you see in terms of like inquiries? Are people kicking tires? Are they trying to use this opportunistically? What do you see there?
Yeah, so we do see a lot of people like there's definitely an uptick of people having unrealistic expectation, right? People coming in for like 50% of the asking rents, and we politely tell them, we cannot accommodate that. But at the same time, we're still doing a lot of leases.
Right.
The average of almost one per day is showing that people are still renting, right? And we are still moving inventory. So
Hmm.
for like a very desirable unit, we can still get it rented like within a week or so coming back to market,
Hmm.
uh, because of the there are still hard demand, and people still need somewhere to live.
Right. And we're going to talk about this later, but I
All right.
know, given where we normally are, concessions are obviously a big thing right now compared to a normal spring. You're seeing some activity there. We're going to get to concessions in a minute down the road, but while we're on Sky and what Ron is talking about, you seeing concessions? How are you seeing them shape up compared to a traditional spring?
Traditional spring, concessions usually cut by a lot. Right now, entering into the spring season with the winter concession kind of still lingering on,
Yep.
because we see the dip in traffic, we're kind of still going full speed at the winter concession. So that's why another reason why a lot of people come into like looking at the market and looking at units to that they have to live somewhere,
Hmm.
accompanying with the winter concession, like a 1 to 2 month free, is still pretty attractive
Hmm.
price point wise to these renters.
And we'll talk about this a little bit later too, but I'm sure the rent versus buy dynamic is
Right.
at play here too. People are probably saying, well, I'm going to hold off on buying until I know where the dollars really end up shaking out. Joe, just pivoting over there, that was sort of sky based data. What's Faro seeing in this sense?
Yeah, first of all, thanks very much for having me on, and I'll be amongst these esteemed panelists.
Thanks.
So sure. With regards to what we're seeing just in the month of May for luxury properties, we define as luxury doorman properties that are more modern, built within the last 5 to 8 years. We're actually seeing that business year over year is roughly 20% comped to last year. But an interesting data point there of roughly 1,100 applications, which I'm anonymizing here. I'm not going to disclose any specific details about the
Right.
applicants. A very high number of them not only accept the application, but proceed to completion. So this is indicative of, yes, there's less traffic, but the applicants that are out in the market and those that do start the application are more serious about securing housing. What we're also
Interesting.
seeing, it's very interesting. So one of the key aspects of our product is we essentially confirm specific financial details like income and assets. What we're seeing here is there's a high degree of authenticity with what's claimed in the application and what's coming through our verification. And that's roughly 68% of the applicants who complete the application have been completely verified for their stated income and assets. And so that means also there are qualified renters in market, which are being very truthful in their applications. So there are qualified customers that are out there looking. And finally, the data is very lopsided for luxury building versus smaller properties, which tend to have less unit makeup and thus less vacancy. And so larger properties have more dynamism around floor plans and views and generally have a higher turnover. And so what we're seeing is larger, more luxurious properties have experienced a disproportionate amount of drop in traffic than smaller properties.
Mm-hmm. Got it. Okay, good. And so, almost your authenticity comment, I think, is interesting, right? So you're seeing this impact is also having a qualitative, influence perhaps on the folks that are looking to rent.
Yes, and what this means is, I think the renters that are truly out there looking there's demand for housing. They're not shopping around. I think
it's real.
It's real, yeah. Exactly. And the market, and typically there's a long search window, and typically renters might be flexible to look at things that are outside their budget. I think people are tapering that behavior greatly, which in fact could be an opportunity. If you're working with a customer now, they're probably more serious in some cases than working with 10 customers, of which maybe 4 or 5 might be serious.
Might even short circuit the life cycle of that shopping window, right? Jared, just pivoting over to your side, what is, you're hearing these two things, how's the data backing up what these guys are talking about from Elegran's brokerage side? What's the volume look like?
Yeah,
as a leaf blower. If you guys hear a leaf blower, that's me, of course. I will go on mute. Go ahead, Jared.
Yeah, thanks for having me. Glad to be here. So sharing some of what we're seeing on the data. So looking at both the rental traffic in terms of inquiries and the sale traffic with regards to inquiries, both of them started declining mid-March, and they both seem to have bottomed out about that second week in April, looking at that week that ends April 10th. And for the rental side, we've actually seen demand double, so 100% increase between the week ending April 10th and the end of last week, compared to only a 50% increase in demand in terms of new inquiries and traffic on the sales side of the market. So what we're seeing is that divergence right now between the rental market and the sales market, where the rental market does appear to be rebounding quicker. And we'll talk about later a couple of reasons why that may be the case.
All right, great, thanks. My leaf blower guy has moved, which is awesome. Okay, so taking a bit of a step back, what are the things that brokerage firms are doing differently to manage this crisis, to get rental deals done? What are concessions looking like? Joe, are concessions a thing you're seeing? Are they required? Are they getting steeper in this environment? Based on what you were saying before, it sounds like there's almost 2 or 3 different versions of people maybe taking those meetings and looking at those options. There may be less needed in some ways, and in other cases, maybe to get the traffic back, there will be concessions needed. Are concessions a necessity in this market?
Yes, they definitely are, and I'm seeing quite a bit of evolution. A couple of caveats. I've been around this industry for quite some time, working through 9/11 as well as the Great Recession of 2009, 2010. And this feels very different and significantly more randomized with its effect, and I'll touch on that in a second. In addition, the effect we're seeing on real estate professionals specifically, whether they be brokers that have in-house exclusives comparable to a firm like Elegran and Sky, as well as just generally the industry that represents inventory, they're under a 3-pronged attack. So the first is working in an ecosystem that now requires almost full virtualization and subject to local laws and mandates that may fluctuate fairly frequently. So they have to adjust on the fly to even harvest that customer. So that's generally new business, attracting new customers. But in addition to that, a lot of these entities are also working with existing tenants and trying to incentivize renewal. And so the incentive delta is different for existing tenants versus attracting new tenants. And finally, to actually close the deal and bridge the deal, it's all about like refining the transaction, because you are going to get lowball offers. And one of the things we've been seeing is People feeling that this is their time to shop and to get the best deal possible. And so I've seen 4 specific types of evolutions. The first is, obviously, we're all aware of an eviction moratorium, structuring deferment for existing tenants, not forgiveness, but verifying, very importantly, verifying their financial hardship is part of that. So it's a very big give on behalf of the owner operator in exchange for proprietary data that the renter is willing to basically requalify for that type of concession. Then there's the rent forgiveness in general, and you might see that in a very rare cases where there's probably a pretend and extend scenario where the renter's lease is about to expire. There might be a lease guarantee that's attached to the property. These are essentially off-book deals that you may not see this particular deal structure become a theme in the industry. And then there's the security deposit and general concession kind of waiver. So more free rent. We've seen a doubling in the offer for free rent for qualified renters on longer term leases with built-in step-up increases into the second year. And finally, qualification requirements for some of our luxury portfolios, which typically would have required 40 to 45 times the rent as income. That is now dropping to 36 and 35. In rare cases, it's dipped even lower. And the credit score, which is really, in our experience, not highly indicative of future behavior, it's indicative of previous behavior, is now dropping to as low as 650. However, the requirement to prove funds or assets on hand has gone up significantly. And what we're interpreting that to mean is it's okay if you're experiencing a blip in income or a reduction in your personal income, but you need to have the assets to essentially requalify for this type.
Right. You got to be able to have the money in the bank. It's interesting because I think, well, let me turn that around. Do you see that credit score flexibility and the willingness to, maybe go not 40x, but maybe 35, 36? Is that associated with longer term leases? Like, are the building owners willing to do that and willing to bend a little bit there if they know they can lock the apartment up?
I will say that two-part answer. For new clients, credit score is actually verifiable. It's part of the application process. However, it's no longer the main driver of future behavior. Cash on hand and assets on hand are now the main focal point of our customers' view of whether this renter is qualified. I'll give you an example. Let's take a foreign renter that may normally not have any credit or thin credit, are still accepted in properties. I'm sure Adam can speak about a tremendous amount of their business is with this particular cohort. And so in this case, credit isn't indicative of their future ability to pay. It's really assets on hand. So there's a bit of that now mixing in with new renters. For existing renters, we're not seeing any validation that owners and operators want to rescreen for credit. That's typically, again, not indicative. They're more concerned with, is this person still receiving the same income at the same level? Are they terminated? Can I detect that? Can I tell? Because I underwrote them when I accepted them a year ago based on entirely different pretenses and financials. How is it different today? So there's a lot more focus on that. So credit, long story short, still somewhat applicable for new applicants. And then really not that applicable for renewing existing tenants. It's assets and cash on hand that's become the main focal point.
Yeah, for us, we're seeing apps all over the country, in almost every state. But specifically in New York, as we look at kind of the risk profile of today's environment and the economic environment, we definitely are looking at employment and tenure of employment to verify that versus anything else. That's actually going to be the number one aspect to approving and denying applicants today. I think it's a lot different than it was, a year ago. We're even seeing a lot of the REITs, both that operate here in New York and nationally, the large REITs, look at things like changing their employment verification process in this kind of economic situation.
Do you guys feel like that is driven by their own risk profile, or do they feel like the default risk has gone up on their renters? They may be pulling their own willingness to take risk up. It may be coming from both ways. What do you guys think?
I think on a public REIT side, it's coming both ways, right? I think the first aspect is they're a public company and they're managing Wall Street's expectations. The risk might not be in their appetite, especially in this declining economic environment. We're talking about record unemployment right now. We're talking about, as as Joe had said, credit is not a amazing way to see people's ability to pay, which I would agree with across the board. We're starting to see things like that's not really going to help occupancy or vacancy loss. So, they are definitely getting out of their comfort zone when it comes to qualifying the qualifications of the residents, and changing their structure. I mean, there's just a lot of risk out there that is beyond their kind of risk profile or appetite. They can't, when you're getting handcuffs saying you can't evict, for the next 12 months, or in LA County, now there's a 12-month payment plan with no proof of financial hardship. It's a different game, and they're adjusting their kind of underwriting and risk appetite accordingly.
Yeah, I think everybody's out of their comfort zone a little bit in how they're looking at everything, how we used to do things versus how we do them now. So Ron, what's the renter's perspective to this stuff? I mean, you deal a lot with the actual boots on the ground, the folks that are walking in to look at employment. What's their perspective on the current market? What are they looking for? What concessions do they expect? Stuff like that.
Sure. They're definitely, like I said, they're definitely expecting more, which is why, some people come in with a super low ball offer, which we, as the operator for, building owners, we still don't recommend anyone to accept like such low ball offer, just because we still see inventory moving, right? With that being said, we are giving very good concessions, meaning like Joe mentioned, we're giving more month free on a longer term lease, right? So if your timeline is, say, you can secure a 2-year lease or even longer, then on the rent concession side, we could give you a little bit more of a sweetener, right? So this is in general how we are dealing with renters, but for a good unit, it's still pretty easy to get it moving and get a good amount of traffic on it, but at the same time, renters do want to see the unit a lot of times, which is why we moved everything virtual starting in March. So that has been a little bit of a hurdle of actually showing the tenants the actual premise of the unit, right? So virtual is one thing. We've done like a very good job presenting it online as much as possible, but the touch and feel is still a factor in that. We did a good amount of deals virtually, but we still sometimes have to accommodate them to going to an empty apartment without being anyone accompanied to actually push them across the finish line.
So we have a question that came in the Q&A, and just so you guys know that we're putting questions into the Q&A, we will get to you if we can. I'm just trying to work those questions into the cadence of the conversation. So one of the questions we have is, so if the lowball offer is 50%, what's the acceptable level of a lowball offer that doesn't get, the other person totally insulted?
I will say 10%.
I mean, right.
Yeah,
I mean, 50 is already pretty tough, right?
Yeah.
Where, just so we know, I don't know this off the top of my head, what would have been an insulting offer before the crisis? Would 50 have even been entertained back then?
No. Even 20, we would not entertain at all, before, especially during the spring. Spring is a time that if you want the unit, you better act today. Otherwise, you're probably going to lose the unit. So there's really not a lot of room for negotiation or even concessions, right? The fact that we're still giving a month to 2 month free as a winter concession is an indicator that it's because the volume is low.
Got it. And while we're here, we have another question in the Q&A that's related to this. The question from Philip is, he's been telling owners to pay the fee based on the assumption that tenants will be reluctant to pay one, and they're all looking for a good deal. What do you guys see out there? And it's sort of an air ball. Anybody would like to, a jump ball, anybody who wants to hop in there can.
I'm happy to chime in there.
Sure.
I would agree. In this market, I believe that tenants want to preserve cash up front. So if they can pay a slightly higher rent and save that money up front by not paying the fee, I do believe that that's actually the right way to go. Not to mention, it actually behooves the landlord to do this. The landlord would need to front that cost, but you have the client, then the tenant locked in at a higher monthly rent. So any subsequent renewal is based off of a higher rent. So it's actually a win-win. It's what's best for the landlord, and it's what the tenant actually prefers. So yeah, it would be my recommendation to have any sort of landlord offer that concession.
Okay. Good, thanks. So you guys mentioned virtual showings, and Ron, you mentioned, somebody doing an inspection in an empty apartment with social distancing and all that stuff. Where do we go from here with virtual showings, virtual notarization, lease signing, and stuff like that? Joe, what do you see there? You guys are right up close, and then Ron, I'll ask you to chime in on that as well from the leasing office side.
Sure. So I'll start with, I guess, the demand that's been generated due to COVID and this pandemic has really made a lot of companies scramble, which weren't already set up for virtualizing their businesses. And there's like 3 stories in the United States based on interactions I've had with my customers that kind of inform on what the impact is. So the first is the well-prepared multi-region open owner operator. Let's use an owner that's got 30,000 units in a southern geography where being able to visit a property physically is completely open right now. And so virtualization is no longer the top of mind kind of pivot for them as to how to accommodate customers. It's more, how do they screen those customers better? So meaning they're not experiencing the same hardship that we experience in more populous states where obviously the spread is significantly wilder. And then there's the owner operator that's a generational owner, which typically is able to structure deals much more quickly, is maybe not using any data to inform them on like real-time pricing mechanisms. And then there's the REIT landlord, which essentially has a ton of SaaS software, which is useless to them right now. Whether they're expecting to get real-time pricing that updates daily based on showings data, that's no longer working. Keep in mind, this is software they're spending thousands of dollars on that's currently not producing value. And in fact, this is a blip. This state will open up. It may close, but I think, and I don't have a crystal ball, I think what we're experiencing is almost like a new state of mind every 2 weeks, especially experientially, as the law begins to change and morph very quickly. For example, today de Blasio announced that the requirement to wear masks in New York City, although it's slightly tampered, will not result in you being arrested. And you'll see, I think, more of that, like, let's open up mindset kick in, even in very populous cities. So this means virtual leasing is not virtual showing. Keyless entry into apartments is still going to continue to be a fast growing way of getting access. I've seen a lot of brokers pivot to that. It's actually an asset to them. It's not a risk to them. They still need to essentially structure the deal, negotiate the deal, market the deal. So what we're seeing, and again, not a prediction, is that all this recent generation of demand for virtualizing the whole process, it's actually been going on for a while, will continue to evolve, but it's getting a lot of attention right now because of the circumstances that we're in.
Where we are. Understood. Okay, great. Ron, anything you wanted to chime in there before we move on?
Yeah, a couple more points. One is, I think, just go along with what Joe just said, right? Like, I think virtual has been a trend, and the COVID situation kind of accelerated the trend, right? Like, before, people were thinking about, should I do a virtual tour and put it online? Now everyone has virtual assets, right? So because of these virtual tours are created already, then this kind of virtual viewing will continue to be offered even after the COVID crisis. And the second point is, I feel like, jumping out of sky, a lot of landlords in New York City are more old-fashioned, right? The landlords, the building owners, they like to touch and feel the paper and actually see the lease, rather than having it in a Dropbox or online somewhere.
A
right?
DocuSign, right? Exactly.
Right. Yeah. So
that's not my signature.
Right. More landlords are being pushed to do all these virtual things by accepting e-signing, by accepting like wire transfer instead of a check.
Right.
So I think once they get over the hump of accepting the virtual closing and the virtual transaction, I think that's here to stay. That's
okay, good. So that moves the needle a little bit further over.
Yeah.
All right, great. So I want to move us along into a different area. So Adam, let's shift over to what the insurance implications are of where we are and where we may be heading. We also have a question that's come up from the floor about, defaults and how what you're seeing and how what you're seeing translates not only into sort of the moment in time we're in right now, but perhaps longer term trends. As we unlock from the tactical crisis into sort of a new world, how are defaults being handled? What's underwriting look like? And just chat a little bit about what the insurance implications are.
Yeah, I mean, so look, let's start with what we have at hand, right? We have a 1 in a 100 year event where insurers are going to take massive losses across almost every industry, from business interruption to real estate to the Olympics. So, the insurance business as a whole, I think, is looking at this in a very different type of way. When we're looking at multifamily real estate specifically, one of the main drivers of default from your rent is unemployment. And as we move to a record unemployment and approach, they're saying as high as 25% unemployment, which is insane. But as we approach record levels that we've never seen in our lifetimes of unemployment, there are a couple of things that we are just not used to. The first is the unemployment benefits. The unemployment benefits are unprecedented, right? They're unprecedented. An unemployed person can almost earn, a living wage, even in New York City, to pay their rent, just on the benefits. And those are talking about being extended into January. Overall, we look at the April and May data, and I'll look at it nationally from RealPage and Entrata. Very, very positive, over 90+% of rent collected. I know we've a little bit different commercial side, and definitely different on the retail side. But in multifamily, it is kind of the best flavor of real estate right now, right? And people are starting to know that. Overall, we've seen default increases, right? I mean, when we have record unemployment and financial hardship in cities like New York, where we have, a large portfolio that we assist, we are definitely seeing defaults. We are seeing defaults in ways of folks kind of dealing with beating the system, right? If the governor is saying, hey, eviction moratorium till August,
right? Don't pay your rent.
Don't pay your rent, and the rent strikes. There's really nothing. Like, there are folks that will take advantage of that, right? And if they really can't do anything till August, they may catch up. They may not. We don't know. But at some point, people will be evicted that default. We are handling defaults across the country. We've seen a good amount of claims come in. I would say our claims have increased about, I would say a little bit, maybe about 20% higher than pre-COVID.
Okay.
I mean, look,
better than I would have expected, actually.
We don't heavily rely in one area of the country. We operate across 46 states, so we have a pretty diversified portfolio.
That's good.
So it ranges from kind of B-class property up to A+ luxury property. I would say overall, I mean, we're handling claims, right? We're dealing with folks. We're dealing with folks on payment plans. We're dealing with folks across the board that have been late or waiting on benefits, such as unemployment benefits or stimulus checks or things like that. There are certain areas of the city that we are not heavily exposed to, but we know that rent collection is a lot lower. So, for example, in parts of Brooklyn and Queens, where it's most of what I'll call the gig economy tends to live, and those are advertising professionals, graphic designers,
coders,
whatever, whatever happens to be. They are experiencing a larger percentage of non-collection of rent. A lot of those buildings are, especially in Brooklyn. And the main reason for that is because those gig opportunities don't exist right now. There is no payment for them.
Right.
So that's,
and like you said, it's taken
area.
a long time for some of these programs to get going. Unemployment, PPP loans, all of that. There's been a real, moment of time where everybody had to hold their breath, and they're getting there now, but there's that huge hole there in the meantime, right?
We can't, systems can't keep up with that. I think that's kind of the bigger problem.
Right.
Look, I think we're seeing a lot of I think this product, lease guarantee insurance, energy deposit alternative type insurances, I think these products before the COVID crisis were kind of a nice to have, right? They were nice to have, a good op for renters and so forth. And I think as we kind of continue post-COVID, I think especially in places like New York and other cities that are mandating that they are allowed to use their security and apply it toward rent, I think you're going to start to see this be a must-have or a need-to-have product for multifamily landlord owner operators.
Understood. How is underwriting changing, or how will underwriting change?
Underwriting is changing. I will say, there are, as I said, rent guarantee insurance or any type of insurance that's interrupting the default of rent has a fine correlation with unemployment. And as unemployment is at record level numbers, underwriting is changing. We're looking at assets, as I'm sure Joe and his team are looking at. We're looking at liquid assets. One thing that's changed, right, you can now borrow against your 401k pre-penalty in this crisis. So it was never a liquid asset that can now be considered a liquid asset that we're looking at. It's definitely affected underwriting in a way that was very different. We look at what types of jobs that they're in, looking at look at what types of employment they have, what tenure they've been in, what percentage of rent to income multiples they're at. We've definitely closed the aperture.
Tightened the spread a little bit, right? From my old world, right? And we talked on one of the prep calls about pandemic endorsements. So you're starting to see that come up more and more.
Yeah, I've seen a new company come out in this type of product that has a pandemic endorsement. And I think that's what our insurers are thinking about, right? This is not risk that you can underwrite in a normal environment, right? This is pandemic risk. This is a 1 in 100 year event. So there are risks associated with that when it comes to multifamily. I think the biggest risk is, if there's an outbreak in a building and it is unsafe for a resident to feel safe and they want to break their lease and default, that is real risk that you cannot underwrite. You cannot underwrite, right? And that's risk. That's kind of what that endorsement is. It's the same as an endorsement for homeowners insurance, right? If falling objects from the sky destroys your home, it's not covered, It's
right, and we saw after 9/11, which was also a 1 in 100 year thing. I joke with some of the Elegran guys that I've gone through 3 or 4 of these once in a lifetime events. It's kind of like enough now. But you had a ton of terrorism endorsements coming along in the insurance industry right after that, because there was no way to underwrite somebody flying a plane into a building, right?
And look, I think there's other things happening too. We work in what's called purpose-built student housing as well, and I think there's issues along that, whether they're like schools are open or schools are closed, and what does that mean? Although it doesn't really affect New York like it does other cities like Boston, where it's a third student population. But you take a town like Gainesville, it's a 20,000. It's literally 60% of the town.
Yeah, the whole town is kids.
Yeah, it's all kids.
Interesting. So while we talk about risk a little bit, I just wanted to pivot us if we could. Adam, were you done? I didn't want to cut you off.
Yeah, I'm all set. Thank you.
All right, great.
Thank you for having us as well.
Joe, the risk mitigation element of this, from your end, and then I'm going to ask Jared to chime in on this as well. The screening criteria that you're seeing, how is that changing? What tools are there to deal with this? You know, how do you see landlords shaping up their thinking around mitigating those risks? Because as Adam was saying, you know, the insurance is there and it's going to become a must-have, but that will have limitations around addressing things like the pandemic.
Yeah, I would say a few things about that. First, I think for the insurtech, fintech industry, this is a watershed moment. I think for any company that has a very conservative approach to underwriting and is going to be able to weather this storm. A. B, though, I think the real picture of how much claims need to be paid and what the true loss ratio would be of these programs, it's not going to shake out for months. And because of the eviction moratorium, you won't actually see what true adjustments in underwriting you're going to have to undertake. I'll also say that just from experience generally, there's been a downward pressure on pricing for these lease guarantee programs and an adjustment of the coverage period as a result. So the programs have gotten riskier with less coverage for the owners and operators. And I would venture to say, just from experience alone, that the majority of the Northeast owner operators who have lease guarantees placed in their properties don't know how they work, and they're now finding out. And I have a customer, 9,000 units, generational owner thinking on a 100-year timeline. So to them, having a lease guarantee is a phenomenal hedge. They are busier than ever before calling the go-to partner that they're currently working with. And I think that's okay. I think this is the reason why lease guarantee exists. It's for times like these. And another dirty secret about that business is it's incredibly profitable. Most customers don't default, which is why these companies can grow. And we can move on to like the second piece here, which is the best time to mitigate risk is now, not now. You should have been mitigating this risk with an overall strategy for underwriting and how you kind of value your process and what's real, what's not, and constantly revisiting kind of that data and informing your team and your model. And what we're seeing from a risk mitigation perspective is a huge leap in the amount of, no pun intended, of personal guarantors, whereas you could still be qualified with a lower multiple, but there has to be a co-signer. And this is very much like a shadow data point that we have this information as a leasing platform. We know exactly the type of guarantor that's been attached to a transaction. And so normally, from a risk mitigation perspective, an owner has artificial levers that they could pull, which is, really by geography, a lease guarantee or a type of insurance program. But then there are non-artificial methods, which are personal guarantors, co-signers.
Just right there, co-sign on the piece of paper. That's about it.
And traditionally, these co-signers have a very high multiple to the rent, are very asset rich. And so we're seeing actually a big jump in the amount of co-signers invited or required on these luxury deals, while there's downward pressure on the acceptance criteria.
Another what you said about the time to have actually mitigated some of this stuff was before the crisis. It's
Napoleon once said that the best time to plant the trees that would have protected his soldiers from the sun was 20 years ago. And
20 years ago.
I love that comment.
Warren Buffett saying, when Warren Buffett says, when you get to see who's been swimming without their shorts on when the tide goes out. Right.
I like that one better.
Jared, let's pivot over to the sort of sales versus rental, question that we know is going through everybody's mind. What about buyers shifting that can't, buyers that want to buy that can't buy right now? Are they renting now? How are they doing a purchase versus a rental when they can't actually go see the place? We've also got a couple FAQs or a couple Q&As rather that I think tie into the purchaser of an apartment versus a renter. So I want to get to that as well.
Yeah, sure. So happy to answer. So tying back to what I spoke about a little bit ago, where we're seeing the rental market pick up a little bit quicker than the sales market, it makes sense because people are more likely to rent something sight unseen than they are to buy something, very simply because the commitment is less, right? It's similar to, you never went and go and visited a hotel room before you booked a week-long stay. So we're seeing that people need to be able to live somewhere. If they have leases come and due, they're not going to necessarily have the time to facilitate a purchase transaction in time for now or later in the summer, early fall, given the time frame in order to complete that. So having said that, we're seeing lease signs, the number of lease signs start to tick back up. We're also seeing rental inventory come back at a faster rate than the sale inventory. So just some quick percentages there compared to last year. So we're looking at week over week, year over year averages there. Sales inventory is down about 80%, but rental inventory is only down about 53%. Looking at it overall for the last 8 weeks, contract signed activity is down 70% compared to what it was this time last year, and 66% for rentals. So those numbers look fairly similar, but when you really start looking at it week by week, that divergence that started happening in mid-April, where the sales market continued to decline in terms of the amount of transactions being signed, and the rental market actually started increasing again. So for instance, in the most recent week, there was about a 62% decline year over year in what was done, what the amount of rentals that were signed, but that's compared to an 85% drop off for sales, right?
So it's like the least dirty shirt. They're both down hard, but sales are down harder.
Correct. Exactly.
Yeah. Okay. And then what about inventory? Like I've looked at this from a macroeconomic perspective as an old economist. What is driving it? Is it a supply side shock or a demand side shock or both? Do you see similar trends in inventory, like what's available for rent or purchase?
Yeah, so both inventories are down, but if you look at it in terms of what motivates either a seller or a landlord to come to market, so they're different. A seller who is living in their home, may very well choose just to wait this out a little bit, right? If they're not distressed, if they're not forced to sell, they're going to just sit tight, not do anything, not sell, in a time of uncertainty. But a landlord, if the unit's coming vacant because either the lease is up and the tenant's not renewing, or it's, the tenant wanted to break their lease or whatnot, the landlord—
Or it's already vacant and it's been vacant.
Already
and they right.
So the landlord has two choices, right? It's leave it vacant and not do anything. Most aren't going to do that. Or, I got to put it on the market and I got to figure out a way to offer some suite of concessions and some, rent that's going to be, attractive in today's market. So naturally, we're going to see rental inventory increase at a faster rate than sales inventory because landlords have to re-rent the apartments. And you also have the seasonality aspect. Most of the leases come up in the late spring into summer, and that's just how it works. So we're going to see that effect now of the summer lease renewals and what's going to happen.
So you've got this wave of renewals coming into an environment that isn't the same as a typical year, right? And I sense, it makes perfect. I guess it's common sense that the transaction impediments for a purchase are higher, right? The dollars are much higher. It's a much more permanent transaction than a rental. You can't see the place right now, so you're looking at going and dropping a couple $1 million on an apartment. That's mentally a different transaction than renting something for $7,000 or $8,000, right? We have a couple Q&As on this too. Like, where do you see? Well, let me rephrase that. Do you see capital coming in to take advantage of this? Where is the smart money, the cash rich, the flush folks coming in trying to take advantages? Are they buying distressed properties? Are they trying to do block deals with owners or building owners and sponsors in order to then rent them out maybe next year? What do you see there?
So there are definitely some larger cash players coming and trying to put money to work. Bulk deals from developers that may be a little bit more cash strapped is definitely one avenue to go. That's a whole separate topic, but every developer is going to be a little bit different in terms of their cash cushion and their financing options right now. We're seeing some money come in and want to buy apartments that have low carry and the ability to get a good ROI. It's a little bit tough to then re-rent it right now, given that the whole market is sort of paused. But we are seeing some money start to flow back in. And if the numbers make sense, they're buying, right? An investor will be more comfortable purchasing something sight unseen because it's really, can I make money in this asset, and do I believe in the long-term appreciation of the building neighborhood, micro market?
Right. And depending on what the price dislocation is, they can be wrong there, right? Like, they don't need to be right on the sightseeing part. If the price is so low and the neighborhood is right, that they know in 5 years they're going to be green. It seems intuitive, but are sponsors and sellers generally more predisposed to an all cash offer still versus a financed one?
They are. There's less risk that's attached to it. So apples to apples, yeah, someone would rather have a cash offer than a financing offer. It's also important just to note that you're not going to see these distressed sellers flashing in bright neon lights that, hey, like, buy me, I'm distressed. You're only going to be able to find that, by going hunting, right? And when I say that, you're going to have to roll up your sleeves. You're going to have to be making some offers. And only after you submit that first offer and have some dialogue will you really understand and start to peel back the onion of what the motivation is for that seller.
Mm-hmm. Mm-hmm. Joe, I know you and Jared had a discussion around concessions. Is there a way to kind of like tie this back to what you see on the concession side with Jared's perspective as a broker?
Yes, I wanted to know, this is based on the assumption that historically I've seen a lot of resistance from owners and operators to drop the price on inventory that's available in the warmer months, because the demand and the ability to just re-rent is just, it coalesces around this is the time where they can get the best value for their units. Has there been discussions around potentially starting to offer 6-month leases that maybe renew at the worst time, but at least defer that decision on long-term financials for that property to see where we are then? Do you see
Yes.
any demand for that? You do? Great.
Yes, absolutely. And just to round it out, we are seeing landlords offer flexible leasing. Now, not every landlord, not across the board, but we are seeing more landlords than ever before, offering tenants to go 3 months, 6 months, 9 months, in some cases, even a month to month. And part of it is because, I'd rather not have the vacancy today. And you also have to look at why people typically moved in the summer. And it was because people graduated college, they started jobs in the city in the summer. But the reality is some of those same jobs may not be here today as companies look to, reassess some of their employment and some of their hiring plans. So the winter may not actually be a bad time for people to move, or from a landlord's perspective, because companies may actually be hiring again in the winter. And just one last thought on this is that before 2008 and the crash, the amount of leases signed in the summer was even more concentrated, right? And only after then, with the recession and people living at home for several months after they graduated, did it start to actually more evenly distribute across the year. People knew that there would be better deals in the winter and things like that. So I think this is another one of those major events that could change the cyclical nature of New York City rental.
At least temporarily, right?
At least temporarily, yeah.
Yeah, I mean,
Sure,
we talked in the earlier webinar today, we talked a little bit about deflation, and there is also going to be that element in all of this for the next year or so, as well as, like you said, Jared, people holding back, seeing if they could get the lower price. That will impact short-term transaction velocity, but it doesn't change long-term demand. That the purchaser is still there. They're just trying to maximize their resources. A couple last things I wanted to cover before we break, and I'm conscious of our time. One of the questions we have is, what are some of the key indicators you guys think are necessary for developers or builders to start a new high rise in New York? I know we're a little over inventoried in the city right now when it comes to new development. Is there going to be stomach for starting new projects in this environment, or is that way down the road? And that's a jump ball. Anybody feel free to jump in.
So it depends on their cost basis, right? So it depends on how much they have the land. It depends on what, their total to market cost is, and if there's still room for a profit where that market is, right? The fact that we're overbuilt is true on an aggregate. I would argue that we have a little bit of a misallocation between the demand and the inventory right now, right? So a lot of the overbuiltness on the sales side is to a market that just doesn't exist, that multinational, multi-million-dollar, trophy apartment in the sky, and the like. But again, to build the inventory that's really in demand, there's a mismatch between the economics of that and what makes it feasible. So we probably will see a shift back towards some of the more boutique projects, which we saw again immediately after the 2008 crash. It was 10, 20 unit buildings. Only in the last couple of years did we start seeing the multiple 100-unit buildings come. So we're going to revert probably back to something like that while this inventory gets absorbed.
Yep. I mean, my old days of being an economist, like I said earlier, the commodity world shows some lessons here, right? Like when copper was really, really, really expensive, everybody and their brother dug a hole and tried to find copper, and that created an excess of supply, which cratered the price. All the mines went out of business, and guess what? The price went back up again. I think New York's exclusivity and its position in the world as a destination place will eventually recover a lot of this stuff and bring us back to trend. but we're definitely at one of, you have a trend line like this, you definitely have, you know, S curves above and below that trend, and we're definitely going to be below it for a little while yet. So
in my opinion, if I could just jump in, I think any
please.
developer who's making it through this process out with their shirt still on has tremendous kudos for being able to kind of readjust their project fundamentals. I've spoken to a few of our customers who are actually developers, they're owners, and they're frankly looking for a massive incentive program. As you know, there's a lot going on that's been anti-owner operator since June of last year. There are rent strikes that are targeting specific landlords. There's tremendous economic asymmetry on the type of incentives that are being offered non-credit private citizens versus the businesses that are going to put all of us back to work.
Yep.
So I think if I may say, I think there should be some very interesting news coming out over the next 6 months about what the local and federal partnerships with owners and operators are going to form in order to incentivize all of us getting back to work. It's really up to them to put us back to work. I think all of us are hopeful for a good future, but it's a bit scary from the perspective of people like us who've been through this a few times. It's not going to be easy. It's not going to be great. The hardship is probably, we haven't hit bottom. It's going to take several months for this to really demonstrate itself through the data. Frankly,
Agreed.
A lot of city agencies are not even open, so none of this data is even real. We don't know what the impact will be. We don't know how much time it's going to take to get back to work. So if I were so humble to say that if I was a builder, I'd wait to see exactly what is shaping up and what is shaping out from City Hall and from the governor's office.
And what capital and what programs are going to be available, right? I mean, I think we're fortunate that interest rates are not going anywhere soon, but you know, that's only one piece of the puzzle. Okay, great. I think I'm going to hold it there. That's a good segue into closing it up. Thanks, Joe. That was a good sort of capstone sentiment around, you know, a lot of what we talked about today is based on very early and incomplete data sets. So, you know, somewhat we can say to be continued. We will know a lot more about where we are in the next few months and what the ascent might look like on the other side. But we really are thankful everybody was able to join us today. We did want to kind of start getting thinking together and get some folks together to talk through where we are. Please remember, this webinar is recorded and will be available to you to come back and hear again if you weren't able to see all of it, or you would like to look at it again or send it on to friends. Please do the survey. We're going to wrap this up now, and we're going to push a survey to you right away. It'll appear on your screen in just a moment. Also, please stay tuned for future emails around future webinars. We want to reconvene the group. We want to continue talking about where we are as additional data becomes available to us, and as we see other things in our own environment, in our own worlds that help inform the future. Thanks again from me as well for all of our panelists. You guys were great. We work hard to make sure that this is relevant information, and I think we did a really good job today. Thank you very much. Thanks again for coming. If you attended the webinar, if we didn't answer your questions or you have others that come, please email the contact person from whom you got the invitation. If it's one of us, please send a note and we'll be happy to answer those questions online. Please stay safe and stay tuned for the survey now. Thanks again.